Victor Dare joins me on the line live from the trading desk. Victor, I'm sure like everyone else, you were very interested to see the market action this week, and certainly recovered much of the loss from the traumatic week the week before.
Yeah, and the markets all do tend to move together. The week before, the market got a case of what I'd call risk off, and we had the stock market down, the commodity market down, and the U.S. dollar up. And this week, no kidding, we had the opposite of that. The way I was looking at the market this week, and for instance, I could just look at the S&P, a great barometer. At the previous week's lows, we were down about 12% from the highs, the all-time highs we made in January. At the end of this week, we're only down about 5% from those highs. But it was interesting. This week, volume was about half of what it was the preceding week. That is, at least in the S&P 500 futures. So what I saw was that the rally back this week was more of a defensive tone rather than the very aggressive buying tone that we'd seen, in early January when everybody and his dog was talking about FOMO, the fear of missing out. You kind of phone your buddies and get into the market. So that kind of aggressive buying. So the tone kind of changed. The U.S. dollar this week fell. We had the euro, for instance, kind of the flip side of the U.S. dollar, hit a 3-year high. The Japanese yen traded to the highest level it's been since the election of Trump. And I focus on the dollar as well as the S&P, for instance, because I think that the U.S. dollar is a good indicator as to the risk appetite, I would say, that either is or is not in the market.
It's interesting. The Canadian dollar, though, didn't follow suit with the euro, and with the yen. It actually was kind of weak, or tepid. Well, how significant would you find something like that?
Well, I do very much pay attention to that. I have felt here for, let's say, a couple of months or so, that the Canadian dollar was, say, maybe the weakest currency of the G10 currencies, the major currencies that we trade, against the U.S. dollar, whereas the euro, for instance, and the Swiss franc were maybe the stronger ones against the U.S. dollar. So I'll look at that kind of thing. I mean, from a trading point of view, I had a couple of good weeks, anticipating and then participating in the very sharp break we had. I started this week past with short positions in the Canadian dollar and in crude. I mean, crude had come off $8 from its highs, and I certainly didn't get all of that, but I had a chunk of it. And then the market seemed to go bid very early, like actually Sunday afternoon and into Monday, and I liquidated those short positions and spent most of the week just sitting on the sidelines watching, because I felt the market was still very much walking on eggshells, and I was looking at technicals to give me a guide as to what was, by that I mean price action on the charts, as opposed to trying to come up with some fundamental justification. And interesting, listening to Stephen Todd, and I have a lot of respect for Stephen, but I saw things a little differently. I thought that this week was perhaps going to be a dead cat bounce, and I wanted to watch for signs that bounce had run out of steam, and then I would take some positions. And I thought I saw some signs of that on Friday, and I took some positions.
Let me just get a quick word from you on gold. Obviously you follow it very quickly. We had a rally, and then it sort of dropped on Friday, I guess it was.
Yeah, and gold, I think, was very similar to the price action in the euro currency. Gold rallied most of the week after having been down the previous week, just like the euro. But with the euro currency, with gold, with the Canadian dollar, and inversely with the U.S. dollar, every one of those markets made a weekly key reversal. In other words, in the case of gold, we made new highs and then trade and closed then below the low of the previous day. And that was the kind of technical sign that I thought that maybe this dead cat bounce, as I'm calling it, was overdone. Now, the most important thing for me when I'm trading is how I manage my risks, and I need to be able to afford to be absolutely dead wrong in whatever I do. So I've taken some small size, limited risk positions. In other words, I bought some puts in gold, crude oil, and Canadian dollar on Friday, anticipating that the markets would go lower next week.
I would also say, you've just reminded me that, so what's the message of the last few weeks? And I think for anybody who was really distressed by the kind of negative action we saw a full week ago. This is a week, it doesn't matter. You're getting a message from your gut maybe that you don't want the level of exposure that you have. And people can't just be passive in this kind of volatile environment. So you've just reminded me, Vic, to remind people that this is a time to review now. You've had a little bounce here. You've got a better opportunity to maybe reduce your exposure. This would be the week to do it, or this would be the time to do it. Although, obviously, if it's in the U.S., we've got a holiday on Monday. But my point being, review the portfolio. If you found that the gut check was really negative, you couldn't stand that kind of volatility. I think there's more volatility to come. So I just think you have to review your positions in this kind of an environment.
Yeah, I'd agree entirely, Mike. Because we got used to extraordinary complacency in the past year, and now I think maybe it's getting back to, I hate to say this, but feels like back to normal, whatever normal is, but I would anticipate more volatility going ahead. One more thought on gold, if I could be quick here. The gold market has been very much the flip side of the U.S. dollar. In other words, when the dollar's strong, gold's weak, and vice versa. But for the past couple of months, gold has not been paying attention to U.S. real interest rates, and that's another very important function of the level of gold. And U.S. real interest rates have been rising very sharply, and right now are back to about the levels they were at the end of 2015. And if gold was to go back to where it was at the end of 2015, we'd be down around like $1,050, $1,100. In other words, a couple of $100 lower than where we are now. So if the U.S. dollar does start to get a bid and gold therefore slips off a bit, then people might go, oh yeah, hey, let's pay attention also to interest rates, and so gold, I think, is a little vulnerable here to falling back.
Victor Adair, you can find him at polarfuturesgroup.com. Polarfuturesgroup.com. Just click on it right there. You get fuller analysis by Victor there. Victor, thanks for taking the time. I hope you go out and have a terrific weekend.
Thank you, Michael, and you too.